Hey everyone, it's Helen from SME Deal Hunter. Today we have Chase Murdock with us, an entrepreneur who owns a holding company, Decada Group, with 5 companies, 3 through acquisition, 2 that he started. Very excited to hear Chase's story. Chase, it's great to have you on today.
Yeah, thanks for having me. Right on.
Chase, let's talk about your background first. How did you get into starting a holdco? What were you doing before, and what just sort of got you into the space?
Yeah, so I've always been an entrepreneur, but primarily in the 0 to 1 game initially. Chasing moonshot ventures, trying to swing for the fences, and raising venture capital. And at some point, got a little burnt out of that game. I felt like I was jumping from one treadmill to another, and I wasn't really satisfied building something that was like meant to be sold or meant to be scaled. I didn't feel that way at the time. I felt like, I was having a good old time and it felt like the thing to do. It felt like the only way to manifest my entrepreneurial tendencies. And I met my current partner, Adam, about 10 years ago at a co-working space here in Salt Lake City. And we ended up hitting it off, went down on a long hike in Capitol Reef National Park in southern Utah, and we dreamt up this idea, this plan, this master plan, where we were going to start a small lifestyle business. Not because we wanted that to be our primary endeavor, but we wanted that to be our kind of side endeavor that funded our next primary endeavor. We felt like there was a major disadvantage when you have to raise capital so early in a startup, and you give up a lot of the cap table. The longer you can go bootstrapped, the better terms you're going to get, the greater your odds of success. And we had this master plan to go start a small business and siphon off cash in order to extend our runway and keep swinging for the fences. And 18 months later, we were doing $1 million a year top line. It was profitable every single month. And we had a hell of a time just shaping this tactile business that wasn't intended to be the next Twitter or the next Salesforce.com. It was intended to just be a Main Street small company. And we thoroughly enjoyed the process of building a team and shaping it every year. It felt like the business was getting a little stronger, a little more streamlined, a little better run. The product was getting better, the service was getting better. And suddenly we looked down and we had a thriving small company. And that was the genesis of Decada Group. So we formed a holding company 4 years ago, but the real story goes back 9 years ago when we started that company.
Got it. And what was the company?
It's a charming little suit shop here in Salt Lake City called Taylor Cooperative. If you're looking to get a luxury suit, Taylor Cooperatives is the largest custom clothier in the Rocky Mountain West. So we started it by signing a lease agreement on perhaps the ugliest space in downtown Salt Lake City for like $960 a month. I remember that lease payment because it terrified me. We started conducting fittings with clients and slowly built out the store. We started the company on $750. And like I said, just every month it got a little bit better. And we hired a general manager early. And we just continued to iterate on the product. And today it's, I think we have 4,000 square feet in downtown Salt Lake. It's a thriving, highly profitable business that has stellar NPS scores, a really interesting and eclectic clientele, and it's led by Caitlin, our operator, who we've promoted from within to task her to oversee the business while we're out making acquisitions and growing Decada Group.
That's super interesting. And what led you guys to go from just starting this one, I guess, original side hustle, which became, a great
Yeah.
thriving small business, to forming a holdco and kind of pursuing acquisitions after that?
Yeah, it was very unintentional. I kind of joke that we slipped and fell and found ourselves running a holding company, which is very atypical. I think on Twitter, holdcos are all the rage, and everyone wants to run a holdco, and they haven't even started or acquired their first company. We were the opposite. We were kind of running 2 companies before we kind of said the word holding company. It was right around COVID time, and my ex-wife at the time was running an art studio called Workshop SLC. And the owner was a thriving, successful artist and was not giving this little business the energy that we felt like it deserved. And she offered us the opportunity to acquire it. And on the other side of the story at Taylor Cooperative, we had a great playbook. Adam and I felt like we were ready to either go open several locations or we weren't sure whether to keep running it as this teeny lifestyle business and just sweeping cash out of it. And that's when we were presented the opportunity to acquire Workshop. And it was in a very different industry. But as we looked at it, it kind of felt like the same playbook we had built could perhaps be like executed in the second company. And like we had this theory that, hey, maybe there is a world in which we can run two companies at once. And, we have an operator over Taylor Cooperative, and yes, like we're meeting with them semi-regularly. We're having effectively board meetings, and we're advising, and we're helping shape the arc of the company. But we're not involved in the day-to-day, and maybe we can go do the same thing over at Workshop SLC. And the way we underwrote the deal was, well, we love the real estate, and even if the business flops, like at least we'll have the real estate. Like that was the level of sophistication that we were at. And it was a teeny business if you think like WeWork, but for artists. That's effectively what Workshop SLC was at the time. They had a small revenue line where they were flying really renowned artists, fine artists, to come out to Salt Lake City, and they would sell multi-day workshops. And that was a growing business line. It was kind of a quirky product. It was kind of a high price point, high margin. And we're like, there's something there. And we acquired it, and we 4 or 5x'd it in the first year, and then we 4 or 5x'd it again in the second year. And so today it's a 4,000 square foot building in South Salt Lake that teaches hundreds of art classes a month, from acrylics to oils to drawing to ceramics and pottery. And it's really fostering a cool kind of creative community out here in Salt Lake. And similar to Taylor Cooperative, it's kind of a consumer brand. It's all about experience. It's all about Net Promoter Score. It's about like really delivering this delightful, memorable experience. And so we got to go to town trying to help craft that experience for our clients, and invest in the building, invest in the business, bring it online, implement a website, start running ads, start acquiring customers. And it really blossomed into a beautiful business. And so that's Workshop SLC. That was company number 2.
Oh, that's incredible that you were able to, not only identify that this was sort of like an interesting niche, but also then grow it. You mentioned growing it 4 to 5x the first year, then again the second year. First of all, that's insane. Congratulations. What was, this playbook you're talking about? Can you kind of walk us through that a little bit? How did you guys grow the suit shop, Taylor Cooperatives, and then, this business as well? What were kind of like some of the key tactics you guys leveraged that worked?
Yeah, I think over time we've kind of learned that this is a competency of ours, is kind of deeply understanding the customer and the kind of ideal customer profile of who we're really trying to provide our product or service to, and knowing who we're after and like who we're not, and being laser, doggedly focused on acquiring those customers in profitable ways. So kind of spinning up digital marketing. So with Workshop SLC, it was bringing a website online. It was running initial ads and figuring out how we can get more traffic to the website, convert that traffic into paying students, and dial in that cost to acquire the customer to be lower than the lifetime value of the value that we extract out of the customer over time, to talk a little tactically. And so it's kind of looking at a sales funnel from a 50,000 foot view downward. And every company, whether it's a B2B services company, whether it's a consumer brand, has an acquisition funnel. And it's either sales led or it's marketing led. And there's fall off throughout that funnel. And there's ways to patch that funnel and improve the flow that attracts customers into your door. And we took just a very mechanical look at both of those companies, and found a way to raise our pricing such where we could afford to spend on sales and marketing. I think that's something that a lot of business owners tend to get wrong, is like almost seeing it as a good thing when you're not spending on sales and marketing. And I get it. Like if you're not spending on sales and marketing, clearly you have a great product, and clearly you're getting organic, evangelist customers out promoting what you're doing. And that's phenomenal. But what that also means is you don't know how to acquire customers repeatedly and sustainably. And to us, it was very important early on to crack that code, because once you crack that code, it really comes down to the size of your market, but you can start pouring gasoline on that fire and growing it. And so, it wasn't like linear growth. It was very much early on spending a lot, being willing to burn down EBITDA and invest cash flow into finding this, And then once that's found, then ramping it. And to be clear, growth is expensive. And those first 2 years were, hell on earth. I think it shaved a few years off my life. Dramatic, but we were losing money. We were trying to decide if we had made the worst decision of our lives or the best decision of our lives. And top line revenue was growing, but we weren't getting profitable up until it finally turned. And now on an EBITDA percent basis, like it's one of our strongest companies in our portfolio. And that kind of validated a loose thesis we had at the time, which is, if you can get a small business really on the tracks and get the product right, get the people right, get the customer acquisition right, at some point, can you start to slowly peel out of the day-to-day and plug in talent to go operate those companies? And I wouldn't have put it that way at the time. I don't think we were thinking about it from that like strategic of a lens, but that's effectively what we were able to do with Taylor Cooperative. And fast forward a couple of years, that's exactly what we did with Workshop SLC.
And for both businesses, how long were you, would you say, working day to day in the business before you were able to, hire those right the operators or just the folks who are, kind of taking over the day to day so you can be a little bit more strategic?
Yeah, I mean, this has changed over time, but early on, a couple of years. I think we look at an acquisition today as you go in and you make a one-time investment to take it through a J curve and really get it to greener pastures. And that one-time investment, a lot of people really just think about that in the form of capital. But we thought about it across time and capital. And we were very willing to go jump in and do a lot of things that don't scale, that felt less glamorous, because it felt like there was this greater goal. We were in there investing one-time capital, one-time time to go stand up systems, implement a CRM, hire and train a team, build that from an employee handbook to SOPs to the playbook that we're talking about today. So, early on, it was, for Workshop, it was 2.5 years. And I think we thought it would be like 4 months, so to be clear, that wasn't the plan. But what we've learned over time is a truth in business is things take twice as long as you expect and cost 3 times as much. And that's been true our entire journey, even as we've honed our playbook and gotten better at acquiring companies.
That's that's so true. I guess after Workshop, how did you guys decide on, were you going to now, you've acquired like which path you're going to go down next, or you kind of open to both? It's, you've obviously done both since, but what was sort of like the plan after that? And how would you compare those experiences initially as well?
Yeah, well, I'll start with that. So starting a company is fundamentally different from acquiring a company. Both are noble, both are challenging, both take an exceptional entrepreneur. But they're two very different breeds of entrepreneurship. 0 to 1 is it's all about scrap, and you're putting in sweat equity, and you're trying to create something out of nothing. It's a form of magic, in my view. It's like the world is against you. The world doesn't want another company to exist, and you have to go like make it a reality against all of those odds. And so it takes someone who's just doggedly scrappy and willing to put in that extra effort. And 0 to 1 entrepreneurs, I look to as just it's quite a talent. It's a very rare talent. It's the kind of person you can drop into a country and they'll be making money within the first week, right? Just it takes this level of tenacity that few have. I also think it's a young person's sport. As we got further in our career, we were like, man, wait, hold up. So we can skip that and we can take a different form of risk in the form of capital and debt and so 1 to 2 or 1 to 10 entrepreneurship of the acquisition game is it's also challenging. It's change management. It's working with people. It's understanding people. It's aligning people's individual goals with a common company goal. It's you have to be an expert communicator. You have to be really good at taking something that has product market fit and is working, and oftentimes go and streamline that. How do you make it easier to acquire customers? How do you make it easy for team members to do their jobs right? How do you, and it's a very different form of like iteration. I liken it almost to like shaping a sculpture. We run a ceramic studio. If you could picture a block of clay, as you're building a company, like in the early days, you're hacking at that block of clay to create what you envision. And then in the second year or two, you're taking out the knife and you're slowly shaping it, and you could start to see, and eventually you pull out the scalpel. And it's a very iterative process. I find it very fulfilling. But entrepreneurship in the 0 to 1 game is quite the opposite. You know, you're breaking things all the time, you're reinventing your company. So in terms of our story, we at some point running Workshop SLC, we looked down and we realized, yeah, we're running a diversified holding company, you know, two businesses. You know, about, with hindsight being 2020, we could go and reacquire this company. And instead of 2 years, I think it could have been 6 months. And instead of burning this amount of capital, I think we could have burnt that amount of capital. And we got cocky and we acquired a construction company. A natural evolution for a holding company is to start in suits and then make your way to fine art and then find yourself running a custom home builder. And we acquired a company called Built by Design Construction. At the time, they had scaled from 0 to a few million a year by saying yes to everything from a $7,000 bathroom remodel to $1 million custom home. And we had this thesis that it was kind of a two-part thesis. Thesis one was we could help them say no to everything except for two things and really specialize a niche. And, you know, really implement a strong sales and marketing funnel and bring about project management best practices, implement technology, plug in a good management team, you know, blah, 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 blah. Thesis number two was, you know what, we really want to get out of these discretionary, not get out of, we want to round out our portfolio and further diversify. And we have two like consumer products that can almost be considered luxury, you know, high-end suits, elective art classes. And we were really attracted to more resilient businesses in the trades. And this was back in 2020, 2021. And we were drinking the Kool-Aid that we're all drinking now in the ETA game of let's just go buy a plumbing company. You know, how hard could it be? And our thinking was acquiring a general contractor would give us an excellent vehicle to go and acquire trades companies. Because if you look at a subcontractor chain, it's usually 40 to 60 subs. You're interacting with them on a regular basis. And we felt like that would give us proximity to go make several acquisitions. So we acquired Built by Design. I got a voicemail a couple days later from a guy named Tim saying, Chase, I'm running an electrical contractor I've been trying to sell for years. I hear you're buying companies. Can I buy you lunch? And we closed on their largest electrical contractor 90 days later. And so we found ourselves in the trades in full force. And it took about 2 years to really kind of acclimate and deeply understand these industries, plug in the right team, you know, navigate, learn a very different type of business. And yeah, those were also two of the hardest years of our lives. We kind of strung together a couple of hard chapters. And that was kind of forging the foundation of Decada Group at the time.
That's fascinating. I mean, closing 2 deals within 90 days of each other is also
Don't recommend it.
insane.
Yeah, I truly do not recommend it. Especially we were buying subscale businesses. You know, these are companies doing less than, you know, several million a year. And I wouldn't call them turnarounds, but there were businesses where like you kind of had to squint to see EBITDA, you know, like you had to get a little creative and have some rose tinted glasses on. And our thinking at the time, right, was like, you know, we felt like we could go effectuate change and create value. And we preferred to buy businesses that were, you know, lower price tag. We don't have outside capital. We're not funded by a fund. We don't have investors. Really, we funded our first acquisition by starting a first company, and 1 and 2 funded 3, and 1 through 3 funded 4, and 1 through 4 funded 5, and so on and so forth. And we've kind of consciously applied that constraint to ourselves where we don't want to be beholden to investors. We want to run our holding company the way we want to run it. And we want to be able to think long-term and operate long-term. We feel like the best companies are those that can afford to operate on a very long time horizon versus like the average public company that's trying to string one fiscal quarter to the next. And also, like, we kind of have this independent streak, me and Adam, you know, like we want to go buy businesses that, you know, are maybe outside of a thesis. And we have a hell of a time learning an industry and coming up to speed on it. And so we feel like today Decada has become almost this lifestyle holding company, if you will. Like I mentioned to you before, it's not like we're selling like surfboards on a beach. Like that's a true lifestyle company. But we're also not we're not in this for the capital allocation and the kind of financial reward. And I don't want to say like it's all altruism. Like we're very much responsible for running a financially strong organization, and the better our financials are, the better we can execute our vision. And we're motivated by money just like anyone else. But I think we made a commitment to ourselves that's really meaningful to us, which is Adam and I kind of agreed we want to create a day-to-day that we don't feel like we have to retire from. And I feel like that's so different from the early years of my career when I was like, do I like this product? I don't know, but I think we can scale it and maybe go raise a round on it. And then who knows, maybe Google will buy us. Like it just felt so like unintentional. And I think like we're finding it's very fulfilling when you can build something purposeful that's in your community that is real, is a company that like you can be proud to have in the community. And if you're lucky, like it could be in the community for decades. So
I love that vision. I love the creating a day-to-day that you don't have to retire from. I very much so feel the same way. I don't know what I would do if I retired, but maybe I'm speaking too early now. Maybe, years from now, I'll say something different. But I'm curious with Built by Design construction, were you guys intentionally sort of looking for a construction company, and like how are you sourcing deals at the time? I know the sort of the workshop SLC was through a personal connection, but after that, were you looking more intentionally for other deals, looking at, like submitting LOIs, or did this also just kind of come to your lap?
Yeah, every single deal we've done has kind of come to us, which we've been very fortunate. We look at deals, we look at broker deals, we throw LOIs out just like the rest of them. And for some reason or another, every acquisition we've completed has been a result of us being in the community, sitting on nonprofit boards, knowing other business owners. And, at that time, putting our flag in the ground and saying, we're Decada Group, we acquire companies, and we're not private equity. We're operators ourselves, and we're looking to be good stewards, and we want to breathe fresh energy to your business and bring, and fund initiatives that maybe you previously couldn't fund, or, help you take your business to new heights when you are ready to retire. I know when we acquired one of our companies, the owner had gotten other offers from competitive companies that were going to fold his team into theirs and pull out a pistol and shoot the logo down that was this man's identity for 27 years. And of course, that's not attractive to a small business owner. And so, he saw us as a really good suitor in the sense that we could promote his team from within, that we would lean on that team to really help operate, and that we would bring some expertise to the table. And over time, we've tried to really hone our message of what Decada Group is about and our ethos and why we buy what we buy and what kinds of businesses we feel like we can be good owners of. And I think that served us well. I think that there's pros and cons to being a community-focused holding company like ourselves. And when I say community-focused, I mean like, we're acquiring in one geography that we're committed to. We're not looking at deals in Florida, like we're committed to acquiring and stewarding companies in our backyard here in Utah. And the pros, well, I'll start with the cons, actually. The cons are like, if there's a banging roofing company in Denver, we're not going to put an LOI on it. Like we're just not looking at great deals in neighboring states or outside of our scope. So inevitably, like we're kind of shrinking the pool that we're fishing from.
Must be tempting though.
What's that?
Must be tempting though.
I mean, you sometimes there's some FOMO, for sure. But I definitely feel like the pros outweigh the cons in that, like, I don't have to spend my life on airplanes. We are truly like building connective tissue in the Utah community. I'll tell you about our startup Durable in a minute, but it's essentially our community building arm where we host events for business owners and facilitate curated peer groups for owners and operators. We do consulting. And there's something really fulfilling about like being engaged in your community. And like when I drive down a street and see one of our like electrical or electric contractor like vans. Like there's nothing more fulfilling. And like when I drive down a road and I can tell my son, like, we built that home right there. Like you see that? Like that structure is going to be there for 30 years. Like we built that. And that's incredibly fulfilling. Coming again off of the career experience I had had earlier of not feeling very proud, I guess. I mean, I was proud of what we were building, but not in the same way.
It's so tangible when it's just in your community, in your backyard. You're helping, you know, I guess foster better relationships with the community. And I think, building your own brand and presence in the community too, I'm sure also just gets you better deal flow, right? Like I think people don't really talk about sourcing deals just by building relationships. It's always like, let me look on a biz
Yeah,
by
because
sell.
in the defense of the searcher, they don't have the time horizon that allows them to do that. Like our deal flow strategy takes like 3 to 5 years to convert. Like it is a very long funnel if you think of it that way. From the moment we shake hands with a business owner at one of our events to the moment we're doing coffee because they're like, hey, like, I'm thinking about selling, but don't tell anyone, and I have no idea how this goes, to the moment that they're ready to entertain LOIs. It's a very emotional journey, and it takes a very long time to do that. And so we've planted a lot of seeds over the years. And today, we look at a number of deals a month. And to be clear, much of it is junk. Like we get Mexican restaurant turnarounds in Southern Utah that, like, of course, like not a fit. But we do get access to some, and long term, I think our strategy is, can we be the first call when a business owner is thinking about selling? I feel like that's a big competitive edge if we can go build toward that goal in mind.
No, that makes sense. I know the first sort of acquisition with Workshop SLC, you guys underwrote it by just looking at the cost of the real estate. But how did you guys think about, diligence, or how did you guys conduct diligence with the construction company and then with the electrical contracting company? Obviously not coming from that space before.
Yeah.
How'd you guys, I guess, run your diligence?
Yeah. I think like fundamentally what we look at is, can we be good stewards to this business? And that sounds fluffy. And so let me unpack what I believe that means to us is, can we bring something to the table that allows us to bring this company into a second chapter that's just as exciting as its first? Like almost like one man's trash being another man's treasure, right? This idea of like, it's a great business. We don't buy bad businesses. We don't buy turnarounds, but we like businesses that have staying power. Our last acquisition had been around for almost 30 years. But we like seeing opportunity in it. And we like being able to underwrite to an EBITDA we can squint and see into the future. And so like we're kind of today in the business of, I wouldn't say transforming, but really shaping companies. I think there's two ways to do ETA, to go and acquire companies. There's a million ways, but humor me on the sides of the spectrum. One is you go and acquire a stable company, bring in debt, and your job is to just not fuck the business up. Sorry, I'm not sure if the language is appropriate for your podcast, but your job is to hold on tight and make sure the business doesn't shrink, and ideally grow with GDP or grow with inflation, pay down your debt. And in 7 years, you'll look down and you'll own the full equity of a company that you bought 7 years ago. And that's compelling. Like that's a really cool way to do acquisition entrepreneurship. The alternative on the other side of the spectrum is you go buy a turnaround for $1 and you jump in and you go and you pull levers and you reinvent the company. And if you're lucky, suddenly you're looking down on a business that's successful. We were kind of like somewhere in the middle of that, where we were buying businesses that were profitable, that had staying power, like I said, that had product market fit, had a customer base, had a team. And our timeline to revenue was like an hour, right? You close on the business and, there's a deposit from a sale that happened that day tomorrow in your bank account. But where the company had a lot of opportunity to go and improve it. And so, we diligence businesses the same way any other acquirer does. We look to ensure the earnings are high quality. We look to make sure that it's a good owner, it's a good seller, it's a good business. But we're operators. We're not capital allocators. We like to really see what the business is capable of. And today it's more we plug in operators and we support a management team. But early on it was very much like, okay, we're signing up for this business for the next 6 to 12 months. Like, let's jump in and let's go figure out how to make it sing.
No, that's super interesting. I guess um going into sort of like the plugging and operator side, I think a lot of people are going to be very interested in your approach there. Obviously, a lot of folks don't want to be running a business day to day and want to bring in general manager, but don't see necessarily a path to that without having worked in the business for a couple of years, maybe like you did earlier on. Can you talk to us a little bit more about how you guys are structuring that, how you're compensating folks, how you're just approaching and incentivizing these operators?
Yeah.
And how you're finding them.
Yeah. Yeah. I mean, fundamentally, this is hard, right? And it should be, because if you boil this down, what you're trying to do is own all the upside and hire someone to go like do it for you, right? And so like if it was easy, everyone would do it. And so like fundamentally, it's a challenge, and I think it should be. I also like really stellar, entrepreneurs or leaders. Why wouldn't they just go buy a company, right? Like, why would they go run your company? And if you find someone who doesn't have that level of ambition, are they really going to be a good, leader of your company? And so like it's this Venn diagram, right? And we found that we have to have a pretty compelling, um, not just comp package, but like career trajectory and reason to be part of Decada for that equation to really crunch. And so we look to today, like if we're looking to recruit an operator, our story is very much around building your career inside Decada Group and learning how we operate and being tasked to go run one of our companies, and then maybe being tapped to go run a new acquisition one day, and then maybe coming in-house to Decada to serve as an operating partner, and like building a career together. And we do a lot of promoting from within, because the way that Adam and I run Decada Group is it's different. It's everyone has a different way, a different style of running their companies. And when someone gets it, our style, that's highly valuable to us, and we work our tails off to keep them around. And so, I think like we've had to get comfortable compensating really well. Early on, Adam and I were not the highest paid people in our portfolio, and I think like to be a successful entrepreneur, you have to be willing to sacrifice up front and being willing to compensate people and give people some upside. We've had many years where we've compensated operators, maybe higher than we had to. And so it's not just about comp, though. I think it's fostering a environment where an operator can be successful. Sometimes I describe it as like, we want Decada Group to be this Iron Man suit that an operator puts on, and like they can be more successful as a result of being part of our ecosystem. So we have leadership peer groups that our operators are part of. We're supporting them through, I wouldn't call it coaching, but mentorship. We help ensure that like they are successful. And so we've looked at some deals where a searcher wants to take a deal down with us and be in the cap table and serve as the operator, and they feel comfortable doing that with us because we're almost like guardrails. Like, we will ensure that not ensure, but we will make try our hardest to ensure this business doesn't go off the rails, and you're coming at this with some expertise. We've also hired folks off Indeed to go run our companies, and I think what we're trying to evolve toward is this long-term funnel, using that word again, where we have this ecosystem of great people in our community that we want to work with one day, and we know what their strengths are, and we know what their proclivities are. And at some point, we want to be able to pick up a deal and be like, yeah, we like this deal. And you know what? This is a great fit for Susie. Now let's go grab Susie lunch and let's go sit down and talk about this. And where our job is really to help pair the management talent with the deal and provide a way to acquire the company and run the company successfully and give the operator upside. I think as we go, like Adam and my goal is to go make a bunch of millionaires, who are running our companies and getting upside and succeeding alongside us. And so, yeah, it's hard. I think like I get that question a lot from searchers. Like, yeah, I want to go acquire a company and then like plug in an operator. And I feel like they're thinking that through very unidimensionally. It's like, okay, why would someone do that for you? Like what's your edge? Like, what are you trying to, how are you going to do that? And so it's hard to build, and I think it should be. And so, one shouldn't go acquire a lower middle market or below company unless they're willing to get their hands dirty for the first year or two and be part of building a job description where someone can step in and thrive and run the business on your behalf. It's a very hard thing to go build.
No, I completely agree. I guess with the operators that you have brought in, I guess
Mhm.
externally, what are some of the traits you look for, whether it's kind of like hard skills, have they, do
Yeah.
they have to have like P&L ownership experience or maybe from the same industry, or, what else, what are some maybe the softer traits you look for? And I guess getting more tactical, how are you structuring that upside that you're talking about? Is it through,
Yeah.
growth in EBITDA? Is it growth in revenue? Like what are some of the things that you guys are doing?
Yeah. So what we look for, a great operator and a great leader needs to have a ton of humility. They need to have high EQ. They need to be able to come into a conversation and listen more than they can talk, understand people, understand what drives people, and be humble enough to do the unglamorous work, because being the quote unquote CEO of a small company is not very glamorous. And so that they need to be willing to do that and have that EQ capability. The other thing that we look for is I just wrote about this recently, and so it's top of mind, but it's perhaps the greatest skill that I think differentiates a great operator from a good operator. And it comes down to prioritization. And let me elaborate on that. If you're running a small company, there's 400 things on your to-do list all the time, no matter what. Good times, bad times. There are 400 things you could go walk into your business and go work on that all add value, that like are all good potential things to work on. Our best operators can look at a list of 400 and identify the 3 to work on and the 397 to either say no to or to delegate. And every operator we've had has been hardworking, and high EQ and talented. And yet what we've noticed is there's some operators who just like stand out, that are just like exceptional. And I think that it's really not a personality trait. It's really not, it's not their resume. It's not like which Ivy League they did or didn't go to. It to me is like, it's the discipline around knowing what moves the needle. In private equity, they talk about pulling levers in a business. It's like knowing what you're going to go do with the company. Like what is, as new owners, can we go change to make this company better? For an operator, it's like, what 3 things could I go do this week, this month, this quarter to go build a stronger business? And that is a very hard thing to do, and it's very hard to teach. We challenge, I think that's where Decada Group can be supportive and valuable to our operators, is like, we are that sounding board. We're that shoulder to cry on when things are bad, but we're also like, when they're trying to figure out like what to go do or what to prioritize, like we can really be helpful in that. And yeah, so that's something we look for. For incentivization, we typically compensate through a good base, and then we align incentives. The fundamental like advantage of a holding company from a capital allocation standpoint is you have this large surface area for potential investments that are likely to return capital in a more performant way than like the stock market or external investments, because you have this internal edge, you have this knowledge internally. And at any given point in time, we could call our operators and be like, what are your top 10 things you would like money for, and help us understand the ROI case. And we can stack rank, 5 times 10 and look at the very best and choose which investments to go like green light. And from a capital allocation standpoint, like that's really cool. And the only way that can be done is if the mothership, Decada Group, has capital to go and make those decisions. And so we sweep excess cash out of our operating companies and up to Decada, and our operators get compensated as a share of that. So that's really the alignment. We're toying with the idea of having operators work for Decada Group and be assigned a company to go work on. So they're paid out of Decada's P&L, and they are quote unquote on a mission for 2 to 5 years to go run a company on our behalf. And they can be shuffled around as they would like to, as they would like new challenges, as they get bored of running a suit company and want to go run a construction company or want to go help us take down an acquisition. And so we've been toying and tinkering with the optimal model for years. And there's no there's no one size fits all. There's no like textbook answer here because again, if it were easy, everyone would do it. It's hard for various reasons.
That's no, that's very insightful and agreed. I mean, it's just there's no easy answer here. But it's helpful to understand how you guys are dealing with this. I guess I'm curious your perspective now that you actually own two sort of more blue collar companies. Um, what has that experience been like, for someone who
Yeah.
maybe didn't come from the trades?
Yeah, I love to evangelize what I'm about to say because like I think a lot of folks underestimate how hard the trades can be. So there's two reasons that the trades can be incredibly challenging. Um, One is recruiting. You're recruiting from a very finite pool of talent. These are licensed either electricians or plumbers or fill in the blank. And each of these trades are shrinking on a year-on-year basis. And it's very difficult to recruit exceptional talent in the trades for that reason. It's a very hard thing to do. I've always thought that we were exceptional recruiters, and that we ran a phenomenal recruiting process from start to finish. Man, we get stumped all the time in the trades. It's really hard. And the number one ingredient to a successful company is great people. And so like it's a huge challenge. The second difficulty is especially today with private equity interest in the trades and is acquiring customers. It's really competitive. We came into the trades thinking we were big shots, like we could come and run ads, and the average electrician probably isn't like running ads, and if they are, it goes to a bad website, and like we could come in and clean up. It's incredibly competitive. Especially in Utah, we have some of the larger franchisors and kind of larger companies based out here, like Any Hour, and man, it's tough. It's tough to own an electrical contractor and bid on keywords against a company like Any Hour, or a large trades company that has electrical, plumbing, HVAC. They can cross sell, they can upsell, they can sell services packages. They have a very compelling use case for the customer, and they can extract a lot of value out of their customers across all of their trades, that they're willing to go and spend more to acquire customers than we can ever afford. And so it's very much a knife fight. It's a great business for a variety of reasons too. It's durable. It's going to be around for decades. Once you do recruit great people, they tend to be very loyal if you take good care of them. They're not complicated businesses. They're hard businesses, but they're simple business models. Running an electrical contractor, you've got to stay busy, you've got to execute the work productively, and you've got to have the right pricing. And if you can do those three things, you're running an exceptional business. It's not rocket science, but it's very hard to go do that. And so like I definitely cringe when I see folks like leaving HBS to go buy a plumbing company. Like you'll find a way to be successful, I'm sure. You're gonna have a hard time, and the trades are not for everyone. And I think that we're still bullish on the trades. We're starting another trades company right now that we're incubating, and we're long on the trades. But it's definitely been a larger challenge than I think we anticipated coming into it.
That's no, that's really interesting and honest perspective, and I think a lot of people would benefit from hearing that. I'm curious, with I guess the construction company, did you ever think about maybe like new construction exposure and things like that? I know a lot of people talk about that with, when looking at various types of trades businesses.
Yeah. I mean, keep in mind we're not very smart, and so like we didn't think about that very much. Today, it's like it's one of our hardest companies for that very reason. You're only as good as your last project. It's a very cyclical, up and down business, both within a year, but then within a decade. Within a decade due to macro trends, within a year because you're stringing together projects, and inevitably you're not like consistently driving revenue month over month. Like you're wrapping a project and you're starting another, and it's just lumpy. I think what got us comfortable with it though is we're in Utah. Utah is one of the fastest growing states in the U.S. We just secured the Olympics in 2034. We've got a strong economy. We performed the best as a state in the last recession. It's a very resilient state. And there's going to be constant demand for a well-run construction company in the state of Utah, and it's on us to figure out if we can be well-run or not. And I think like we acquired it without debt. Like we weren't too dumb. Like I would definitely never recommend acquiring a custom home builder with debt. I couldn't fathom having a high debt service while running this construction company. So, we came in full equity. We felt like it was a differentiator just to have a line of credit, which most home builders or construction companies do not. And yeah, I think our thesis was like, man, there's so much demand that like as long as we can actually pick up the phone and like run a decently organized company, like we will surely be able to edge out the competition. And what happens in recessions is very scary for construction in the sense that the really, really big construction companies start taking large jobs instead of really large jobs. And then the large construction companies start taking medium-sized jobs instead of large jobs. And it just cycles down and it burns out. It literally like evaporates the chuck in a truck construction companies because they just don't have a brand equity. They don't have staying power. And so like it's very tough to be a smaller construction company. So we've been very aggressive about growing the company and staying laser focused on our niche. We're one of the largest builders of ADUs in the state of Utah. And an ADU is one of those accessory dwelling unit tiny homes that you build in your backyard. And it's a niche angle, and we like it because it's a niche angle. And so, yeah, we run it conservatively. We don't allow that company to take on debt. We run it very differently, and we've made a ton of money in that company, and we've also had dry times in that company. But yeah, I think if you were to look at the earnings, we've kind of earned off of that company against the capital we put in. It's probably our top performing company. It's a well-run construction company throws off a ton of cash. And you have to have great management. You have to have a really good operator. But yeah, if there's one company that kills us, it's definitely going to be our construction company. And so we're just structured to make sure that it's not in a position where it could.
Yeah, no, that makes sense. And I know we're old past time now, but one final question from me. One thing we didn't really discuss, but you kind of alluded to, I guess, in all these various deals, especially in the acquisition side, how do you guys structure these deals? For the construction company, obviously all equity. But how did you structure that deal as well as some of the other deals that you guys acquired?
Yeah, I mean, every deal is different. I think like it's really powerful once you kind of understand deal structuring and you've been through it enough where it's like there's a million ways to structure a deal. And there's usually a more optimal way based on the context of who the seller is and what their interests are, based on the volatility of the business. So we've done a couple SBA deals. We've done 2 off the balance sheet. We do a lot of seller notes. I think principally it's important for the seller to have skin in the game. And we don't like to, we've only done this once, but we don't PG seller notes. Like it's these are sellers need to be engaged, and I want to make sure that they are incentivized to pick up our call in the event that we need it. So we're big on seller notes. We're big on bringing as much equity to the table as we can. Like I worry about this trend of like on Twitter how to go buy a business with no cash down. It's like that's it's negligent. And as interest rates have risen, I've talked to in the past 2 months, I've talked to 3 or 4 entrepreneurs who acquired their companies who have either filed for bankruptcy or thinking about filing for bankruptcy. They brought in debt on a variable rate, and as interest rates have done what no one could have predicted over the past 2 years, like they found themselves in an untenable position. And there's risk in 0 to 1, like we talked about, and there's a different form of risk in the 1 to 10 game, and that's usually using the SBA program in the U.S. at least to go personally guaranteed debt. And while the failure rates are better in ETA than they are elsewhere, still a rate, there's still failure. And we've never really been through a climate like we've been through over the past 5 years with the post-COVID bump, with low interest rates, and then with higher interest rates. And it's a very scary time. And so I'm not against ETA. Like I'm kind of against the folks who publish the tweets on how to buy a company with no cash down. It's just it's hard. And hopefully, in the conversation we've had today, hopefully you've heard that. Like we've had a hell of a time. And we're grateful for it. We've learned a ton, and we're sitting on a holding company that's performing well, and we're excited about the future, and it worked. But there were multiple sleepless nights, and there was a lot of work that we put into it. And so, yeah, ETA is an awesome way to build a career. It's a great way to build wealth. And I think going in with your eyes wide open on the risks and the rewards is a really important thing for people to do.
No, 100%. I think most folks listening, are probably, one of the only options if you don't have a ton of capital is obviously to go SBA, and it just is. There's another reason why you really need to do your diligence, and the deal needs to not just pencil out, but like pencil out exceptionally.
And that's a good point. Yeah, not everyone has the advantage of having one business throwing off cash where you can afford to go put 30% down. I get it. It's tough, but I think as long as folks understand what kind of risk they're taking on, go get it. I mean, I've taken multiple risks in my career, and that's the only reason I'm here, So yeah, you've gotta have appetite for risk, but you've also got to have sober eyes looking at the risk that you are taking on.
100%. And I totally agree. I really hate people who mention, buying business no money down without actual details, because how that generally happens is not just like you're putting no money down, but it's like, you're raising money from investors, you're getting a seller note, maybe you're combining all those things with an SBA loan, but it's not just like there's no risk whatsoever. And it's just, zero to, you put zero down, you own a multi-million-dollar business, and
I've
it's
seen
not that
too
simple.
much personal destruction to be tolerant of that kind. It's it's doable, but that doesn't mean your odds of success are likely. But so I'm glad we agree on that, because it's a hard journey, but it's a very fulfilling journey, and I could think of no better way to build a career than what Adam and I are so fortunate to spend our time doing.
Absolutely. Well, look, I know now we're well over our time, Chase, but this has been great. If people want to reach out after, listening to this interview, what's the best way for them to follow you or reach out, or just, continue following your journey?
Yeah, I'm spending a lot of time writing these days. So I started a blog newsletter called Local Legends on the craft of company building. And it's really easy to find if you find me on Twitter or LinkedIn under Chase Murdock. And yeah, if anyone wants a second set of eyes on a deal, or if we've got the time, we'd be happy to be helpful and help ensure others are able to get into the game and find success with them.
Sounds great. Thanks so much, Chase. Thank you for
Yeah,
your
thanks a lot.
time.